When is a share not really a share? I mean, today, we're looking at a financial instrument that, well, it acts like a chameleon.
Right, a very clever disguise.
Exactly. It dresses up in all the legal paperwork of equity. It literally carries the title of a share, and it even promises to turn into a standard piece of company ownership down the line.
Yeah, but underneath that carefully constructed disguise, it might actually be a ticking time bomb of debt.
It's wild. So welcome to a brand new deep dive for the Gap Advisors Ind AS Clinic podcast.
Glad to be here.
If you are an auditor defending a tough call, a CFO navigating, complex capital structures, a finance student trying to bridge the gap between theory and reality, or just someone fascinated by the hidden mechanics of corporate finance, you are in the right place.
Absolutely, because our mission is to take the incredibly dense, sometimes just completely impenetrable language of Indian accounting standards and translate it into the actual real-world impact it has on businesses.
Right. Because we're going to look past the labels that companies slap on their contracts and dig into the underlying economic reality.
Yeah, because in the modern financial world, the name of a contract rarely tells you the whole story. It just doesn't.
It really doesn't. And to help us decode that reality, we are pulling today's fascinating mystery directly from the issue repository on gopadvisors.com.
Which is just a fantastic resource.
It really is. It's a staggering resource for anyone in the field. I mean, it hosts over 4,500 real-world issues and their detailed responses regarding Ind AS and Indian GAAP.
Yeah, and any person can register for free, right, and submit their own issues on Ind AS and Indian GAAP for a detailed response.
Exactly. Delivered directly to the inbox of the email that you registered with on gopadvisors.com, which, is extremely helpful, particularly for auditors who need to document how they addressed any issue on the application of Ind AS.
It gives you that verifiable trail.
Totally. And to be specific, the case we are tearing apart today was featured in the 222nd edition of the Gap Advisors Task Weekly newsletter.
Yes.
Yeah, that newsletter is authored by C.A. Manish C. Iyer, the director of Gap Advisors, and is published on LinkedIn.
Right.
And with over 230 editions published to date, it's really a continuous pulse on the most complex accounting issues popping up in the market.
Having access to that volume of resolved practical queries is, well, it's fundamentally different from studying a textbook.
Oh, completely.
Textbooks give you perfect, clean scenarios, The Gap Advisors repository gives you the messy, complicated, contradictory contracts that actual businesses are signing every single day.
The real stuff. Now, before we put one of those messy contracts under the microscope, we do have to lay down some foundational ground rules.
Right, the disclaimers.
Yeah. So the views expressed during this discussion are the personal views of the author and are not binding on the audience.
Very important point. We are exploring the interpretation of complex standards for educational purposes. So the audience is requested to seek the help of an expert before taking any action or refraining from any action based on the views discussed here today.
Because every contract has subtle nuances that can drastically alter the accounting outcome.
Context is everything.
It is.
And to give us that context for today's hypothetical company, we are operating in an environment where the functional and presentation currency is the Indian rupee, the INR.
Okay, Indian rupee. Got it.
Furthermore, the reporting period we are referencing is a standard financial year running from the 1st of April to the 31st of March.
Right.
Keeping the rupee in mind as the functional currency it's going to become a major plot point when we start hunting for regulatory loopholes later on.
Ooh, I love a good loophole hunt. So consider the stage set. Let's look at the contract that started this whole debate. I was going through the facts of the case from the Gap Advisors source, and we have a hypothetical entity, but let's just call them Company X.
Okay, Company X.
They went out into the market to raise capital, and they issued something called Compulsorily Convertible Preference Shares, or CCPS for short.
Right, CCPS.
Now, on the surface, that sounds like a very standard, if slightly wordy, corporate transaction. But before we get to the specific quirks of Company X's deal, we need to make sure we are speaking the same language.
Yeah, let's define the terms.
What exactly is a preference share, and how does it fit into a company's capital structure?
Okay, so think of a company's capital structure as a ladder of risk and reward.
Okay, I'm picturing a ladder.
At the very bottom, taking on the absolute most risk, you have the common equity shareholders.
Right, the founders, the everyday stock market investors.
Exactly. If the company goes bankrupt, they are the absolute last people to see a single rupee.
Yeah.
They get whatever is left over after everyone else is paid off.
Which might be nothing.
Often is nothing, but Because they take that massive risk, they get the voting rights. And they get the unlimited upside if the company becomes, say, a billion-dollar unicorn.
Okay, so they own the residual value. If the company is a pie, they don't get a guaranteed slice. They just get whatever crumbs or, massive leftover chunks remain in the pan.
That is a very good way to visualize it. Now, move to the very top of the ladder.
All right.
Up there, you have the senior secured debt, the banks.
The lenders.
Right. They take the least risk. They have a guaranteed interest rate, a guaranteed repayment date, and if the company defaults, they have the legal right to seize the company's assets, sell them, and get their money back first.
So they're safe.
Very safe. But they don't care if the company becomes a unicorn. Their upside is capped at their interest rate. They just want their money back.
So where do preference shares sit on this ladder?
They sit right in the middle. They are a hybrid instrument.
Hybrid.
They have a preference, which means they are higher up the ladder than common equity. If the company pays a dividend, the preference shareholders get paid their agreed-upon dividend first.
Before the founders see a dime.
Exactly.
Yeah.
And if the company goes into liquidation, the preference shareholders get their initial capital returned to them before the common equity holders get anything.
Okay, so they have a safety net that common equity just doesn't have.
Mm.
But they aren't quite debt either, right?
No, they're not.
Because the company isn't legally forced into bankruptcy if they skip a preference dividend, whereas skipping a bank loan payment triggers an immediate default.
You've hit on the exact tension there. Preference shares have some characteristics of equity, like you said. They don't usually force bankruptcy on a missed dividend, but they also have characteristics of debt, like fixed returns and priority in liquidation.
There's a messy middle ground.
It is. Now add the next layer from our specific case.
Right, the compulsorily convertible part.
Yes. This means they don't stay in that middle hybrid zone forever. The contract dictates that they must, without any option to back out, eventually convert into those risky, bottom-of-the-ladder common equity shares.
Oh, I see. So the investors get that downside protection as preference shareholders for a specific period of time, but they are legally locked into becoming full common equity partners eventually.
Yes. It is essentially delayed equity.
Delayed equity. I like that. Now, I noticed in the case facts for Company X, the timeline for that delay is quite long. The CCPS are slated to convert into equity shares after 15 years.
Right, 15 years.
That seems like an eternity in the corporate world. I mean, why would a company and an investor agree to a 15-year runway?
It is a substantial horizon, I'll give you that, but it's actually quite common in certain sectors.
Really? Like what?
Think about heavy infrastructure projects, toll roads, massive manufacturing plants, or deep tech research and development.
Oh, capital-heavy stuff.
Exactly. These are ventures where you have to sink billions of rupees into the ground or into a lab for a decade before you see a single rupee of profit.
Ah, so the investor says, look, I'll give you the money now to build the factory, but I want the safety of a preference share while you are in the risky building phase.
Spot on.
And then once the factory is humming and generating cash in year 15, I'm happy to convert into normal equity.
That is the exact commercial logic. The instrument is designed to match the risk profile of the underlying business project.
Makes total sense.
However, Company X's contract has an interesting modification.
There's always a twist.
Always. The investor doesn't necessarily have to wait the full 15 years. The holder of the CCPS has the right to exercise the conversion option before the 15 years are up.
Oh, wow. So the investor holds all the cards there. It's mandatorily going to happen at year 15, but the investor can pull the trigger early.
Yes, exactly.
So if Company X builds that factory in 5 years and it becomes wildly profitable ahead of schedule, the investor can just say, forget the preference safety net, give me my common equity now so I can get full voting rights and maximum upside.
And crucially, the company cannot force that early conversion. The option is entirely in the hands of the holder.
Interesting.
But up to this point, everything we have discussed, the preference status, the 15-year timeline, the early conversion option, it's all relatively standard financial engineering.
Standard stuff.
But here is the linchpin. This is the detail that caused Company X to submit their query to the JAP Advisors Repository in the first place.
Okay, lay it on me.
Upon conversion, whether it happens early or at the 15-year mark, the holder will receive a variable number of shares.
Variable. I saw that word variable in the source document, and it seemed to change the entire complexion of the deal.
It changes everything.
The contract explicitly states that the exact number of equity shares the investor receives will depend on the fair value of those shares at the time of conversion.
Right.
I need to walk through the mechanics of this because it feels completely counterintuitive to how I understand investing.
It can be tricky. Let's build a scenario to contrast a normal conversion with Company X's variable conversion.
Okay, let's do it.
In a traditional fixed convertible instrument, the ratio is locked in on day one. You invest 100,000 rupees, and the contract says in 15 years, regardless of what the company is worth, you get exactly 1,000 common equity shares.
That makes total sense to me. I'm taking a risk. If the company's crushing it in 15 years, and those shares are worth 500 rupees each, my 1,000 shares are worth 500,000 rupees. I made a massive profit. But if the company is failing, and the shares are worth 10 rupees, my 1,000 shares are only worth 10,000 rupees. I lost almost my entire investment.
Yep.
I'm sharing in the actual equity risk of the enterprise.
That is true equity participation. You are exposed to the volatility of the company's valuation.
Right.
Now let's look at what Company X did with their variable clause. The investor puts in 100,000 rupees today, but the contract says, in 15 years, we will look at the market price of our equity shares, and we will give you a variable number of shares, however many it takes to equal your initial 100,000 rupee investment.
Plus maybe a guaranteed predetermined return, right?
Often, yes.
Wait, let me run that math in my head. If the company is doing terribly, and the shares have plummeted to just 1 rupee each.
A disaster scenario.
Right. The company has to issue 100,000 shares to that investor just to make them whole.
Yes.
And if the company's doing amazingly well, and the shares are worth 1,000 rupees each, the company only hands over 100 shares to the investor.
You have mapped out the mechanics perfectly. Now, look at the risk profile of that investor. Are they taking any equity risk? Are they exposed to the downside of the company failing?
Not at all. They are totally insulated. They are guaranteed to walk away with 100,000 rupees worth of value, no matter how badly the company performs. The company is basically acting as a shock absorber for the investor's capital.
And that leads us to the central query of today's deep dive. Under the rules of Ind AS 32, does this specific transaction with its guaranteed value and variable share count get classified on the balance sheet as a financial liability? Or does it get classified as equity?
I'm going to put on my lawyer hat for a second here.
Okay, let's hear it.
Or maybe just the hat of a really stubborn CIO who wants this to be equity. I'm looking at the legal paperwork. At the top of the page, in huge bold font, it says preference shares.
Right.
Throughout the document, it talks about converting into equity shares. The word share is the operative noun in the entire contract. I don't see the word loan. I don't see debt. I don't see bond.
Nowhere to be found.
Exactly. So how could a document that is entirely focused on issuing shares possibly be classified as liability? Doesn't the legal form dictate the accounting?
That is the exact argument that finance teams have had with auditors for decades.
I bet.
It is the exact reason why the standard setters fundamentally changed the philosophy of accounting. Your argument relies entirely on legal form.
Right.
But Indian accounting standards, specifically paragraph 15 of Ind AS 32, operate on a doctrine known as substance over form.
Substance over form. I was reading through the underlying logic of Ind AS 32, and it basically mandates that you have to classify an instrument based on the substance of the contractual arrangement, not its legal title.
Yes.
But why? Why did the accounting profession decide they couldn't trust the legal titles anymore?
Because financial engineers became too clever.
If
accounting relied purely on legal form, a company could take out a massive restrictive bank loan, but as long as they titled the contract, say, special preferred equity investment, they could hide that debt from their investors.
That sounds dangerous.
Very. They could make their balance sheet look incredibly healthy while secretly being drowning in obligations. We saw this historically with various corporate collapses where immense amounts of debt were hidden off balance sheet or disguised through clever legal structuring.
They had to close that loophole.
Exactly. The substance over form doctrine is a direct response to that. It forces the accountant to strip away the legal disguise, ignore the title at the top of the page, and look strictly at the underlying cash flows and obligations.
So if it walks like debt and quacks like debt,
The standard forces you to call it debt.
that is a profound shift in perspective. It means the auditor has to act more like an economic detective rather than just a legal clerk checking boxes.
An economic detective, I like that.
So we have to take Company X's contract and put it through this economic X-ray machine.
We do.
But before we do, The Gap Advisor source makes a very specific note in point 1 of their response. They state that their analysis is strictly limited to the classification of these shares under Ind AS 32 and explicitly does not deal with the measurement requirements, which fall under a completely different standard, Ind AS 109.
Right.
Why is that firewall so rigid? I mean,
Way.
why don't we tackle classification and measurement together?
Because they are sequential and fundamentally different exercises.
How so?
Classification under Ind AS 32 is an exercise in structural identity. You are asking what is the fundamental nature of this economic agreement. You are sorting items into 3 distinct buckets: financial asset, financial liability, or equity.
Okay, 3 buckets.
You cannot proceed until you have definitively placed the instrument into one of those buckets.
Because the bucket dictates the rules for everything that follows.
Exactly. And AS 109, which handles measurement, is a massive, mathematically complex standard. It dictates how you calculate fair value, how you amortize costs, how you account for the time value of money, and how you recognize impairment.
Sounds like a headache.
It can be, but the rules in Ind AS 109 are totally different depending on which bucket the instrument is in.
Right, that makes sense.
If it's equity, the measurement rules are relatively straightforward. If it's a derivative financial liability, the measurement rules are incredibly volatile and complex, requiring constant recalculations that hit your profit and loss statement.
So you have to know what it is before you can figure out what it's worth.
Exactly. You cannot apply the mathematical formulas of 109 until Ind AS 32 has told you what the underlying identity of the instrument is.
That clarifies it perfectly. Classification is the gateway. So today, we are just trying to get through the gate. We are leaving the complex Black-Scholes valuation models and Monte Carlo simulations at the door.
Thankfully.
We just need to know if this CCPS gets sorted into the equity bucket or the liability bucket. To do that, we have to navigate the core rules of Ind AS 32, specifically paragraph 16. I look at paragraph 16 as the ultimate litmus test for equity.
It really is an unforgiving gauntlet.
Unforgiving.
Yeah, paragraph 16 states that an instrument is an equity instrument if and only if it meets 2 very strict conditions. There is no partial credit.
Wow. Pass and fail.
Exactly. If you fail either condition, you are immediately expelled from the equity bucket and dumped into the financial liability bucket.
Let's break down these conditions. I was parsing the dense language of Condition A. It essentially says that the instrument cannot have any contractual obligation to deliver cash or another financial asset to someone else. It seems pretty straightforward on the surface.
It is the bedrock definition of a liability. A liability is an unavoidable obligation to transfer economic resources.
Okay.
If you take out a loan, you have an unavoidable obligation to hand over cash on a specific date. You don't have a choice.
Right.
Equity, conversely, is the residual interest. True equity holders have no guaranteed right to cash. The company only pays them a dividend if the board of directors decides to declare one.
Right, it's discretionary.
Exactly. If the company hits hard times, the board can legally just stop paying dividends to common shareholders, and the shareholders can't force them into bankruptcy.
So if a company issues a preference share, but the contract says the company must buy that share back for cash in 10 years, a mandatorily redeemable preference share that fails Condition A immediately, right?
Absolutely.
Because they are legally forced to hand over cash.
So the mandatory cash payout makes it a liability, regardless of the share title.
Okay, let's apply Condition A to Company X. The contract for their CCPS says they're going to convert the preference shares into equity shares after 15 years. They aren't promising to hand over cash. They are promising to hand over their own shares.
Right.
So it seems to me that Company X easily passes Condition A. They have no obligation to drain their bank account to settle this deal.
You are correct. If we stop reading the standard there, Company X looks like it has successfully structured an equity instrument. They have avoided the cash obligation. But the standard setters were anticipating exactly this kind of structural workaround. They knew companies would try to settle debts using their own shares instead of cash to avoid liability classification.
Crafty.
That is precisely why paragraph 16 has a Condition B.
And Condition B is where the trap snaps shut. This part of the standard deals specifically with instruments that are settled using the issuer's own equity instruments. It's broken down into 2 parts, one for non-derivatives and one for derivatives.
Okay.
Let's start with the non-derivatives, which is the primary contract itself.
Okay.
Clause BI says that if the company is settling the contract with its own shares, there can be no contractual obligation for the issuer to deliver a variable number of its own equity instruments.
Right. There's that word again, variable.
Why is variable the fatal flaw here? I need a robust way to understand why the standard is so allergic to a fluctuating share count.
Accountants often refer to the underlying principle here as the fixed for fixed doctrine.
Fixed for fixed. Okay.
To truly understand why variability is fatal, we have to step away from corporate shares for a moment and look at the fundamental nature of settling a debt. Let's build an analogy.
Let's do it. Make it concrete.
Imagine you run a small business and you have taken out a loan from a wealthy friend.
All right. I'm the borrower.
You owe this friend exactly 1 million rupees. The debt matures in 1 year. The normal, expected way to settle that liability is to simply transfer 1 million rupees in cash from your bank account to theirs.
Very simple. I have a 1 million rupee liability.
Right. But let's say you are cash poor. You don't want to drain your liquidity. However, you happen to own a vault full of gold bars.
Nice problem to have.
You propose an alternative to your friend. Instead of settling this debt with cash, I will settle it using my gold.
Well, gold has intrinsic value, so my friend is probably willing to listen to the pitch.
Exactly. But there are two fundamentally different ways you can write this gold settlement contract. Scenario 1. You tell your friend, I will give you exactly 150 grams of gold on the day the debt matures, regardless of what the spot price of gold is on that day.
Oh, wow. In that scenario, the dynamic between us changes completely. My friend isn't just a lender anymore. They have essentially taken a speculative position on the price of gold.
It is that.
If the global gold market spikes, that 150 grams might be worth 1.5 million rupees. They make a huge profit. If the gold market crashes, it might only be worth 500,000 rupees, and they take a massive loss.
Yes.
They are completely exposed to the risk and reward of the asset.
They have accepted an ownership risk. This mirrors true equity. You are exchanging a fixed obligation for a fixed amount of an asset, transferring the risk of valuation to the holder.
Okay, that makes sense. Fixed for fixed. What's the second scenario?
Now, let's look at scenario 2. You tell your friend, I owe you 1 million rupees. I don't know what the price of gold will be in a year, but on the day the debt matures, I will look at the market rate, and I will hand over a variable amount of gold, however many grams it takes, to equal exactly 1 million rupees.
Wait, so if gold is incredibly expensive, I might only have to hand over, say, 100 grams.
Right.
But if the gold market completely collapses, I might have to back a truck up and unload 500 grams of gold just to hit that 1 million rupee threshold.
Precisely. Now analyze your friend's risk profile in scenario 2. Are they taking any risk on the price of gold?
None at all. The price of gold is totally irrelevant to their bottom line. They are guaranteed to walk away with 1 million rupees worth of economic value.
Zero risk.
If I can jump in here and build on this, the gold in scenario 2 isn't an investment. It's just acting like a gift card or a store credit. I'm not investing in gold, I just have a 1 million rupee credit, and you happen to be paying out that credit using gold bars instead of paper currency.
That store credit analogy captures the economic reality perfectly. In scenario 2, the gold is merely a substitute currency being used to settle a fixed liability. The variability, the fluctuating amount of gold you have to hand over, is the exact mechanism that ensures the underlying value remains rigidly fixed for the investor.
This is a massive revelation. If we map this analogy directly back onto Company X and their CCPS contract, the shares of Company X are the gold bars.
Yes. When Company X promises to deliver a variable number of equity shows based on the fair value of those shares after 15 years, they are executing scenario 2.
It's the exact same thing.
They are telling the investor, we guarantee you a specific amount of economic value. We will use our own shares as a substitute currency to pay you that value.
Wow.
Because the company is using its shares merely as a settlement currency for a guaranteed value, the substance of the transaction is a debt obligation. The investor is artificially insulated from the true equity risk, the risk that the company's value might plummet. Therefore, this mechanism blatantly violates Condition B of paragraph 16. It fails the equity test.
The mechanism of variability is literally designed to prevent the investor from acting like a true equity owner. It's brilliant financial engineering, but the accounting standards see right through it.
They really do.
Just to be thorough on the rules, Clause BII deals with derivatives, like options or warrants. It reinforces this same concept, right? It says a derivative must be settled only by the issuer exchanging a fixed amount of cash or another financial asset for a fixed number of its own equity instruments.
Yes, that is the explicit statement of the fixed for fixed rule. If you issue a stock option, the holder must have the right to buy a fixed number of shares for a fixed price, say 1,000 shares at 50 rupees each.
Right.
If the price fluctuates based on an inflation index, or if the number of shares changes based on a performance metric, it fails the test. The variables are no longer locked, the investor is no longer taking pure equity risk, and the instrument must be classified as a derivative financial liability.
So Company X has been dragged through the gauntlet of paragraph 16, and they have categorically failed. Their variable share clause means the underlying substance of their CCPS is a financial liability.
Unquestionably.
But, I know enough about the world of compliance and regulation to know that a general rule is rarely the final word.
Oh, never.
Right. The landscape of financial reporting is defined by its exceptions, its carve-outs, and its highly specific loopholes designed to protect certain industries or policy goals. Surely Company X's lawyers went hunting for a loophole to save their equity classification.
Any rigorous analysis requires testing the exceptions. The JAP Advisor's source material meticulously walks through two major exceptions found within Ind AS 32 to determine if Company X can find a safe harbor.
Let's dive into the first one mentioned in the source. This is tucked away in paragraph 16b2, and it involves something called a foreign currency convertible bond, or FCCB. The standard apparently has a highly specific carve-out for equity conversion options embedded in bonds that are denominated in a foreign currency. Why does this exception exist, and how does it work?
To truly understand this exception, we have to look at the historical context and the tension between international rules and Indian economic reality. The source material highlights a crucial difference between Ind AS and pure IFRS international financial reporting standards.
Really? I always assumed Ind AS was just a copy-paste of IFRS, slightly adapted for the local environment.
They are largely converged, yes, but the deviations known as carve-outs are where the most intense regulatory battles were fought. And this FCCB exception is arguably the most famous carve-out in Indian accounting history.
Let's set up the problem. What happens under strict, pure IFRS rules if an Indian company raises capital abroad?
Imagine an Indian infrastructure company needs to raise capital. Domestic interest rates are high, so they go to London or New York and issue a convertible bond denominated in US dollars.
Okay, borrowing in dollars.
Let's say they borrow $100 million. The contract has a seemingly perfect fixed-for-fixed conversion option. In 5 years, the investor can convert that fixed $100 million debt into exactly 10 million fixed equity shares of the Indian company.
That sounds flawless based on everything we just discussed. Fixed cash for fixed shares. Paragraph 16 should be perfectly happy with that, classifying the conversion option as equity.
It would be happy if the world only used one currency. But remember our ground rules from the very beginning of this deep dive.
The functional currency of the Indian company is the Indian rupee.
Exactly. When that company brings the $100 million obligation back onto its rupee-denominated balance sheet, a massive problem emerges.
The exchange rate.
Yes. The rupee value of that $100 million obligation is constantly moving. If the exchange rate is 80 rupees to the dollar today, the debt is 8 billion rupees. But if the rupee depreciates and the rate goes to 90 next year, the debt is now 9 billion rupees.
Oh, wow. So from the perspective of the company's rupee balance sheet, the amount of debt being settled is actually variable. It is fluctuating wildly based on macroeconomic forces entirely outside the company's control.
Precisely. Under a strict purist interpretation of IFRS, because the local currency amount is variable, the instrument fails the fixed-for-fixed test.
So it's a liability.
Yes. The international rulemakers declared that a foreign currency convertible bond must be classified as a financial liability, specifically a derivative liability.
And if it's a derivative liability, that triggers the measurement rules of Ind AS 109, right? The ones we talked about avoiding earlier.
Yes, and that is where the disaster strikes. Derivative liabilities must be marked to market at fair value through the profit and loss statement every single reporting period. This means that every time the rupee-dollar exchange rate twitches or the company's own share price moves, the fair value of that derivative liability changes. The Indian company has to record those massive non-cash swings as sudden gains or huge losses in their P&L.
That would make their earnings look like a roller coaster. Investors would be terrified of the volatility. It would essentially punish Indian companies for accessing cheaper foreign capital.
It was seen as an existential threat to Indian corporate balance sheets during the transition to Ind AS. So the Indian standard setters made a pragmatic, policy-driven decision.
They created the carve-out.
They created the carve-out.
Mm.
Ind AS 32 diverges from IFRS and states that if the only reason the instrument fails the fixed-for-fixed test is because the fixed amount of cash is denominated in a foreign currency, India will look the other way.
Wow.
Ind AS allows the company to classify that conversion option as equity, shielding the P&L from that chaotic FX volatility.
That is an incredible piece of accounting history. It's a customized legal shield designed to protect domestic companies. The million-dollar question is, does this customized shield protect our company X? Can they use the SCCB carve-out to save their variable CCPS?
Let's refer back to the core facts of our specific case. Did Company X issue their compulsorily convertible preference shares in US dollars or euros or yen?
Well, point 4 of the Gap Advisor's response is definitive on this. It says, Company X has issued compulsorily convertible preference shares in its functional currency of Indian rupee.
And with that one fact, the shield evaporates.
Gone.
The exception is surgically narrow. It applies exclusively to instruments denominated in a foreign currency. Because Company X issued their instruments in their own functional currency, the Indian rupee, there is no foreign exchange variability to forgive.
Right.
The variability in Company X's contract is entirely self-inflicted by their 15-year fair value clause. Therefore, this massive loophole is completely useless to them.
Door number 1 is slammed shut and dead-bolted. The FCCB carve-out cannot save them. But the standard has another potential escape hatch, right? The source material brings up a second exception.
Yes, point 5 in the source document addresses the pro rata existing owner exception.
The technical language here is really dense. It says the exception applies to the issue of rights, options, or warrants to acquire a fixed number of the entity's own equity instruments for a fixed amount of any currency if the company offers these rights pro rata to all of its existing owners of the same class of its non-derivative equity instruments.
It's a mouthful.
Let's decode that. What real-world business transaction is this designed to protect?
It is designed to protect standard rights issues. Let's say you are an early founder of a company and you own 10% of the shares. A few years later, the company needs to raise more money to expand. If they just sell new shares to an outside venture capital firm, your 10% ownership gets diluted. You might suddenly only own 5% of a larger pie.
Founders hate dilution. They want to protect their voting power and their slice of the profits.
Exactly. So, to be fair, the company will do a rights issue. They offer you and every other existing shareholder the right to buy new shares at a specific price in exact proportion to what you already own. If you buy your pro rata allocation, you maintain your exact 10% ownership stake.
So if a company offers a mathematically fair fixed deal to everyone who already owns the company, purely to let them maintain the status quo, the accounting standards say, we aren't going to penalize you. We will let you keep classifying that transaction as equity.
Correct. The standard recognizes that these are internal capital-raising mechanisms between the company and its existing owners, acting in their capacity as owners. It shouldn't suddenly spawn complex derivative liabilities on the balance sheet.
Could Company X argue this? Could they say, hey, we only sold these variable CCPS to our existing founders, so we fall under the pro rata exception?
Even if they did sell them exclusively to existing founders, it wouldn't matter. The trap is right there in the specific wording of the exception. The rule explicitly states that it only applies to rights or options to acquire a fixed number of the entity's own equity instruments.
It always comes back to the variability.
What did Company X issue? The source states, Company X has issued compulsorily convertible preference shares that are convertible to a variable number of equity shares.
The variability poisons the well across the entire standard.
It does. The pro rata exception demands a fixed number of shares. Because Company X engineered a contract designed to guarantee value through a variable share count, that single decision disqualifies them from the general rule of equity, disqualifies them from the foreign currency exception, and completely destroys their ability to use the existing owner exception.
It is inescapable. They tried to build a hybrid instrument that offered the safety of guaranteed value with the upside potential of equity, and the Ind AS 32 X-ray machine saw straight through it. They have run out of hiding places.
Yes, they have.
Which brings us to the verdict of our deep dive. We've analyzed the anatomy of the deal, we've rigorously tested the rules of paragraph 16, we've explored the historical context of the exceptions, and the results are in. What is the definitive accounting fate of Company X's CCPS?
The conclusion provided by the Gap Advisor's response in our source material is unequivocal. Point 6 states clearly, As the compulsorily convertible preference shares are convertible into a variable number of equity shares, the condition in paragraph 16BI is not met, and therefore the instrument shall be classified as a financial liability.
A financial liability, not equity, despite the name preference shares, despite the fact that they are legally forced to convert into equity in 15 years. The presence of that single variable mechanism forces the entire transaction onto the liability side of the balance sheet.
That is the uncompromising reality of the substance over form doctrine.
We have established the technical answer, but I want to spend the final part of this deep dive translating that technical conclusion into the real-world stakes. What is the so what of this classification?
The real-world impact is huge.
Let's step into the shoes of the CFO of Company X. They designed this instrument. They pitched it to the board. They thought they were building a massive, safe equity cushion to fund their 15-year expansion plan. What happens to the daily reality of that company when their auditor comes in, reviews the gap advisor's precedent, and says, nope, this 500 million rupee transaction is actually a financial liability?
The fallout is not just an academic footnote. It is a catastrophic cascade that hits every single vital metric of the company. Let's start with the most visible metric to the outside world, the debt-to-equity ratio.
That is the classic gauge of a company's leverage.
Yeah.
It tells banks and investors how risky you are.
Exactly. Let's put some hypothetical numbers to this to see the damage. Imagine Company X, before issuing the CCPS, had 1 billion rupees in debt and 1 billion rupees in pure equity. Their debt-to-equity ratio is 1-to-1, a very healthy standard ratio.
Okay, 1-to-1?
They need to raise 500 million rupees for their new factory. They issue the CCPS. The CFO thinks, great, this is equity. Now I have 1 billion in debt and 1.5 billion in equity. My ratio just improved to 0.66-to-1. I look incredibly safe.
But then the auditor drops the hammer based on Ind AS 32.
The auditor reclassifies that 500 million as a liability. Overnight, without a single fundamental change in the business operations, the balance sheet violently shifts. The debt is now 1.5 billion. The equity remains at 1 billion.
Oh boy.
The debt-to-equity ratio violently swings from a healthy 0.66-to-1 to a highly leveraged 1.5-to-1.
That makes the company look drastically riskier on paper. And that isn't just an optics problem, is it? That has legal consequences with their existing lenders.
It triggers the most dangerous domino in corporate finance: bank covenants. When Company X took out that initial 1 billion rupee bank loan, the bank almost certainly included a covenant, a strict rule stating that Company X must maintain a debt-to-equity ratio below, say, 1.2-to-1. If they go above that, they breach the covenant.
Oh, wow. So by the auditor simply moving this CCPS from the equity bucket to the liability bucket, Company X suddenly breaches its banking covenants.
Exactly. And breaching a covenant is a technical default. The bank suddenly has the legal right to demand immediate, full repayment of the 1 billion rupee loan.
But they don't have the money.
Exactly. The company doesn't have 1 billion rupees in cash sitting around. They spent it building the business. This accounting reclassification can trigger an immediate liquidity crisis that pushes an otherwise operational company into bankruptcy negotiations.
That is terrifying. A single word, variable, can trigger a technical default. And the damage doesn't stop at the balance sheet, does it? What happens to the profit and loss statement? Because if it's a liability, Ind AS 109 measurement rules kick in.
The P&L takes a massive hit. If this CCPS is a financial liability, it means there is an implied cost to that capital. Even if Company X isn't paying out cash dividends right now, Ind AS requires them to recognize the cost of that liability over time. They have to start recording a massive non-cash interest expense in their P&L every single quarter.
So their reported profits are artificially dragged down.
Their profits plummet, their earnings per share EPS collapses. Now imagine the CFO trying to go public or trying to raise a Series B round of funding. Investors are looking at a highly leveraged balance sheet that is dangerously close to covenant breaches and a P&L that is bleeding interest expense from a complex variable rate liability. The investors will demand a massive risk premium. The company's future borrowing costs skyrocket.
It is a complete chain reaction of negative financial consequences, all stemming from a misunderstanding of paragraph 16. The CFO thought they were being clever with a guaranteed value structure, and instead, They built a trap for themselves.
Which is precisely why relying on deep, authoritative precedents is not just an academic exercise. It is a vital survival skill for finance teams, CFOs, and particularly for the auditors who have to enforce these rules. You cannot afford to guess how a variable clause will be interpreted. You have to know the consequences before the ink dries on the contract.
And this highlights exactly why the resource we utilize for today's episode is so critical to the industry. I really want to emphasize the immense value of the Gap Advisors repository in preventing these exact kinds of corporate disasters.
It is an indispensable tool. When you are dealing with stakes this high, where a misclassification could trigger a bank default, you cannot rely on a quick skim of a standard or a vague memory of a textbook. You need tested, rigorous precedent.
And what I find so impressive is the accessibility of this knowledge. This isn't locked away in some expensive, exclusive consultancy firm. Any professional, any student can register for free on gapadvisors.com. Once you are registered, you don't just get to read past cases. You can submit your own complex real-world issues regarding Ind AS and Indian GAAP directly to their team of experts.
It fundamentally changes the dynamic of how professionals handle regulatory uncertainty. If you are reviewing a contract with a bizarre hybrid clause and you aren't absolutely certain how the fix-for-fix doctrine applies, you don't have to operate in the dark.
You submit the query, and you get a detailed, robustly argued response, just like the one we dissected today, delivered directly to the inbox of the email you registered with on gapadvisors.com. I imagine this is an absolute lifeline for auditors in particular.
Think about the auditor's position in the scenario we just built.
Yeah.
The auditor is the one who has to walk into the CFO's office and deliver the bad news. They have to tell the CFO that their carefully planned equity is actually a covenant-breaking liability. That is an incredibly tense, high-stakes meeting. The CFO is going to fight back. They are going to bring in their lawyers. They are going to argue legal form. They're going to try to stretch the FCCB exception.
The auditor is going to be under immense pressure to back down and just let it slide as equity.
Exactly. And as an auditor, you have a professional and legal obligation to comprehensively document exactly how you addressed complex issues regarding the application of NAS. You need a verifiable, airtight trail of your logic and the authoritative guidance you relied upon. Having a detailed, expert response from a repository with over 4,500 resolved issues provides that armor. It gives the auditor the rigorous, objective foundation they need to stand their ground, make the tough calls, and defend their position against intense pushback.
It removes the subjectivity. It isn't just the auditor's opinion against the CFO's desire. It is an objective application of the standards, backed by a massive library of precedent.
It is the ultimate backup in a field where getting it wrong can cost millions.
We have covered a tremendous amount of ground in this deep dive, moving from the foundational definitions of capital structure through the unforgiving gauntlet of Ind AS 32, exploring the historical anxieties that birthed the foreign currency exceptions, and detailing the real-world devastation of a balance sheet reclassification. As we wrap up this analysis, I want to leave you, the listener, with a final provocative thought to mull over.
The accounting standards are essentially a mirror held up to the complexity and sometimes the hubris of human agreements. They force us to strip away the marketing and confront what economic promises we have actually made.
We've seen vividly today how the word variable acts as a lethal poison pill for equity classification. It's a tiny contractual mechanism that completely changes the DNA of a financial instrument. So I want you to think about the complex contracts that your own company or your clients are drafting right this minute. Are you negotiating a joint venture agreement? Are you structuring an employee stock option plan with performance metrics? Are you raising convertible debt with a valuation cap? Is there a hidden variable clause, an earnout, or a flexible settlement mechanism tucked away deep in the fine print? Because if there is, it might be secretly acting as a time bomb, waiting to turn what you thought was a solid foundation of equity into a massive covenant-breaking liability.
It is a chilling prospect, but a necessary audit of your own assumptions. The devil, as they say, is always in the variability of the details.
Before we officially sign off, I want to sincerely thank you, our audience, for dedicating your time to this rigorous analysis. Navigating the depths of Ind AS is not for the faint of heart, but achieving that clarity, seeing the underlying mechanics finally click into place, is deeply rewarding.
Thank you for embarking on this intellectual journey with us. The pursuit of economic truth over legal form is a continuous challenge, and we hope we've brought practical clarity to a very complex corner of the financial world.
If you found this deep dive valuable, I want to make a very specific request. Please follow or subscribe to the Gap Advisors Ind AS Clinic podcasts on your platform of choice. We are readily available on Spotify, Amazon Music, and YouTube. Whichever of those platforms you prefer to use to listen to the Gap Advisors Ind AS Clinic podcasts, make sure you hit that subscribe button so you never miss a technical breakdown.
And beyond subscribing, please consider the impact of sharing this knowledge.
Absolutely. I make an earnest request to you. Share this deep dive among your professional network. Send it to your contacts, discuss it with your colleagues, and share it internally with your audit and finance teams. And I want to make a special plea. Please share this directly with students who are currently pursuing their CA course. The transition from memorizing textbook theory to applying these standards to messy, real-world contracts is the most difficult part of their journey. Sharing this content helps spread crucial practical knowledge on the actual application of Indian accounting standards. It helps build a stronger, more rigorously informed financial community for everyone.
Knowledge in this field is the one asset that actually appreciates in value the more you divide it and share it with others.
Well said. Remember that economic X-ray machine we talked about today? Accounting might not be as perfectly binary as physics, and the corporate waters will always be muddy, but with the right tools, like Ind AS 32, and the vast precedents within the Gap Advisors repository, we can see straight through the legal jargon to the actual bones of the deal. Keep looking past the labels, keep questioning the substance of the contracts you sign, and we will see you on the next deep dive.
Keep questioning the form. Goodbye.